Good evening, friends. Welcome to the special subscriber webinar wherein we answer your queries. Could you just let me know if you can hear my voice clearly through the chat window? We will begin the webinar shortly. Just let me know through the chat window whether you can listen. Thank you, sir, Mr. UP Singh. Thank you for letting me know this. Yeah, we'll begin this by 4 o'clock. Let's so that other people can also join it. So just have patience for just 4 more minutes, and I will start by 4 o'clock. Thank you, friends. Now we will begin with our webinar on subscriber queries. The first question is by Mr. Anand Joshi. He wants to understand the meaning of return on net worth, TTM sales variant, and quarterly sales variant in choosing stocks. Yeah, since this is a basic fundamental question, I will not go to any specific stock. Return on net worth basically means that whatever the capital that the company has invested, uh, net of its current liabilities, or whatever the capital it may have invested in it, uh, how much return it is generating. So as we communicated to you last time when we introduced the value creation index, think of it this way. If you were to start a business, you took 100 crore rupees and invested in it to create a plant, and if that plant is generating later on a profit or EBIT of about 10 crores, then it would mean that you are earn based on the asset is generating a return of 10 percentage or 10 crores for you. Now, how is it relevant? See, looking at return on net worth on its own, it might not, is not a very good way of selecting stocks. The very because some businesses are very risky. So while they may have very high return on net worth, they would also tend to have very high capital that cost of capital that the banks may charge them when they take debt. The investor expectations from them, because they are high risk, so investor would also expect a high return. So a much better way of looking at it is how much incremental return on net worth or return on invested capital that they can earn over and above their cost of capital. So that is where our new valuation matrix helps. So if you look at case like Asian Paints, for example, I'll take you through two extreme cases. Let's get into a 10-year X-ray pro. So if you see the ROCE of Asian Paints has been very high. Value creation index is the index that we have created. It is basically a simplified version of saying how much return on capital employed or return on net worth. Both ratios are trying to measure the same thing, are high compared to its cost of capital. So as you can see, value creation index of an Asian Paints has been consistently been very green. So this means that company has been creating lots of value for its shareholders, at least as far as the business is concerned. So this is one. Let's look into a extreme on the other side of extreme case, a big company again. Let's look at Hindalco. So if we see value creation index, you see that Hindalco, since the time it took over Novelis, and it has not been doing that well. Its return on net worth has been very low. See, if you see, the return on net worth also has been very low numbers. So it's not surprising to see that the value creation index as such is also negative or a very red number. So by looking at value creation index is a much better way. I would not suggest to just go through using looking through return on net worth or return on capital employed independently, because it has we have seen at times that there are cases in which the return net worth is very high, but the value creation index is also very high. So let me see if I'm correct in my assumption. I think Havel should fit that criteria, in which while it has very high return on net worth. uh, okay, let me see some other company. Oh, sorry. Yeah, I have to go to 10-year X-ray Pro to see the value creation index. Yeah, so if you see in the current year, if you see last 2 years, while the return on capital employed has been very good, uh, largely, but if you see it's an value creation index has been very negative. So while yeah, the numbers are good if you see independently, but because of the business risk that the business has, we see that Bajaj Electrical might not be very good play. If I had to go back to Havels, I think it would work for Havels also. Yeah. Oh, so I was of the mark for Havels. Havels, unlike Bajaj Electricals, very high return on capital employed, but and very high value creation index also. So it has worked very well for Havels. But in the in between two period in which it took European company called as Sylvania, it didn't work out. Understandable because it had taken a very big debt also in order to finance it, and well, now that the Sylvania has turned around since March 2011, it Havels has been doing very well. Okay. uh, the other question about yours, how relevant is TTM sales numbers, or let's say even I suppose you are also thinking about TTM EPS number or quarterly growth numbers are relevant. They are relevant as far as to understand whether the expectations of the market are met or not. So let me take a company in point, because market has had very high expectations from this company. So if you were to see, the company had clocked generally very high growth rates, but if you were to see that the December numbers, the growth has marginally been weak in the December compared to 32 that it had been clocking. The December growth has been weak, and the March was a very very rude surprise. So if you were to see at the price chart, let us say, you would see typically that this kind of company wherein it has the growth has collapsed a bit, or growth has been very very stressed for some time, you would see that the prices typically will collapse. So if I were to take, let's say, 3 months, you would see the prices will typically tend to come down. Why? Because the market expectation of the return has not been met. uh, Even if I were to take out, let's say, the last 1 month, if I were to take out last 1 month of problem that we had, and take, let's say, go to January to February, you would see that the price has come down a bit from, say, assuming, let's say, March results to whatever the numbers have been. Okay. Market expectation, if it is been met, then typically it should do well. uh, Other thing that you may be interested in is to understand that quarterly numbers in itself need not be very relevant for some sectors. These would typically be capital goods company, engineering oriented companies, because in this the product life cycle itself is a large cycle. So it is not necessary that each every quarter on quarter they may give a good growth. Much of the time the numbers may be too lumpy in nature. They may happen much more towards the March end or towards, say, December end. Other is some seasonal companies. Companies have Some companies do have seasonal businesses. Let's say if you look at cement companies, then it's not very good to look into them on quarter basis. Year on year makes much more sense, because uh, typically construction activity is very weak during the monsoon season. So the September results will be typically be very weak compared to its previous, and quarter two results will be typically be weak compared to quarter one numbers. So quarter on quarter might not make very well relevance. So if you are looking out for, say, 6 months oriented time frame or 3 months oriented time frame, then results do make very sense. However, unless and until the results are too big a surprise either on the positive or the negative result, at least for the large companies, do not matter much till they broadly meet what the investor expectations are. So that is one caveat that I am adding. Till they broadly meet what investor expectations are, uh, small changes in the result compared to the hype that has been made in the media does not matters much. So if you are expecting a company to grow by 16%, and if it grew by 15.5%, so it's not as if the company has underachieved what the expectation was. The next question is by Mr. Rakesh Gupta. His question is Bale is rated as green star in 10-year X-ray. Is this okay? Please note EPS and sales for FY 2013 are red, not good. Value creation index for March 2000 is not provided. Net operating cash flow for March 2012 are negative. Order pipeline is weak. Yeah, Mr. Rakesh Gupta, all the considerations for Bale are well taken. The thing why we continue to believe that Bale is actually a green company and actually a star company. Let me put. Let us delve into the 10-year X-ray. Okay, sorry. So if you look, uh, one why value creation index has not been provided for March 2013. See, because to create value creation index, I need to look into lots of numbers. Those are balance sheet related numbers. I need to do lots of analysis that can be done only once the annual report comes in. So once the annual report comes in for Bale and some of its other large peers, you can see the value creation index for the following year also. So yes, it is a bit delayed with respect to the information, but it is a very relevant information and a very stable information as such. The second query of yours is with respect to yeah, the EPS and the sales number have been weak, and the thing that has to be noted is that while the EPS and sales number have been weak, they have been largely because order pipeline has been weak, and this is because of much more regulatory issues. It is not something that we think of it as a something of a long-term phenomenon that is happening in BHL. It is not like it is not a case like Infosys wherein you see that the management is not striving enough well to meet investor expectation. This is an economic scenario weakness that is happening. So unless until our expectation builds up that we in India would not see a future wherein more power plants would be built, more infrastructure expansion would happen, uh, BHEL will continue to remain as a star company for us, because we are not seeing it. The weakness in the number does not mean that the company is losing its path. It just means that the economics of the company as of now, the economic environment in which the company is working as of now is very harsh environment for it to give very stellar numbers. And because of this reason and because of this primary reason, we are giving a contrarian call on BHL. So is this likely that BHL may even say be another see another 10% or 15% negative from your buy price? Yes, it is very very likely because it's a contrarian call. I really do not know where the bottom is. What I generally know is that this is the period in which the economy it is seeing economic weakness, its order pipeline is weak, is a period in which a company like BHEL is much more better to buy in. So if I were to take you through seeing BHEL's performance, oh, if you were to see PHEL as such, let's say, you will see that in March 2007 to 2006, BHL was much at a higher pace than where it was as of now, and it has come down considerably since then. It is not as if the company's revenues have not increased. It is not as if the company's profitability has not increased. On the other side, the increase, the negative on the net operating cash flow in 2013, while I still need to work on my numbers, but I would not be surprised even if that happens, because if there is a business weakness period in which unless until it becomes a trend wherein it would continuously see a negative operating cash flow always coming in, I would not be much surprised for a company like BHEL. It is not a case like say opto circuits, because in opto circuits you would have seen not a single period of net operating cash flow being negative, but each and every period in which the net operating cash flow was negative. So a trend would be definitely terrify me, but one off case would not be such much of a problem for as far as I am concerned. So for BHEL, while our target holds, the only cautious note I would add to each and every investor is for companies like capital goods sectors and those who are in metal sectors, while we strongly believe in our targets, so unless and until there is some regulatory issues, we would not make major changes in it. But largely, our target is with respect to the fact that it would give, end up giving superlative returns to the investor over next 4 to 5 years. We have a laundry list that we would like things to happen before, and we would see these things to these kind of companies to really pay off. But when they would pay off, the payoff would be much larger than what we have seen in recent past with let's say some pharma companies, or let's say some FMCG companies. So these are bail at the current price of say around 174 is effectively a large multi-bagger, if I can say that. But is this going to happen sometime very soon? No, unlikely. I believe this would happen only over next 2 to 3 years. In that short duration, yes, it can likely see 10 to 15% correction in the price. But given the fact that recent few decisions been taken, one on the gas price hike, I would expect gas power plants to start picking up. Again, the same we also know that what about 2 months back, the CERC has also taken a decision that they would allow pass through of coal price increase. That I also believe would allow even coal power plants to start picking up. So I believe this both of these decisions would be very helpful for BHEL. These are one of the few decisions that we were looking out for. We believe that over next two uh, 2 to 3 years, BHEL will do extremely well. I hope Rakesh Gupta sir, this answers your question. The other question is Hindustan Zinc is rated as green star in 10-year XA. Is it okay? Share price has constantly fallen during last 6 months from 140 to 97. I understand the tension that most of my investors have with respect to metal companies as such. If you see, each and every metal company has corrected a lot, and that's why we believe that these are very good prices to enter. As far as Hindustan Zinc is concerned, it's a very simple common sense, and if you think through this common sense basis, you would not be surprised that most of the other analysts also who may be giving out uh, uh, targets for Hindustan Zinc, all are converging towards the same, and 140, 147 number. The number is very simple. If I were to say on a very common sense Banya method, uh, while the company's share price may be somewhere around 97 yesterday and 102, but even if you were to think of 97, we need to think this way. There is a very large buyer who is willing to pay 147 rupees to the government of India for the residual stake that government of India has it in Hindustan Zinc. Is this something that is easy to do for government of India? Unlikely. It is not a very easy thing for government of India to do, because it may require parliament to clear it. But having said that, disinvestment of Hindustan Zinc is something that government can easily take out, in the sense that given the weak market conditions, it can get substantial premium on Hindustan Zinc through Vedanta. And this premium that the amount that it can get would be somewhere close to 17,000 to 20,000. Given the fact that the finance minister has budgeted for a fiscal deficit of 35,000 crores, this meets substantially the fiscal deficit target of the government. If you were to see other disinvestment that the government has done recently, MMTC was done at a 65% discount. The other Nivelle Lignite is going through a strike. Compared to them, the case for Hindustan Zinc and Balco is much more robust, because in this a major part of the stake has already been sold to a private party. Only a small amount of stake is remaining. This is one reason because of which you would see that now we consistent continue to maintain the Hindustan Zinc price of 146. Let's however take a different view. Let's say this investment would not take place. What would happen that? So that's why if you go through Hindustan Zinc, you will see that there is a note that we have put up, which is indicated by the bell symbol. If you were to go through that note, let's see. We explain our view of why Hindustan Zinc would do well. Broadly speaking, I'll take you through the brief in this note, because this point comes again and again with respect to Hindustan Zinc. If you see the zinc prices as such in this graph, they have moved through at least 5 different phases. Yeah, two of them being the bearish phase, one being the extreme positive phase, other being a light positive, and the last phase, which we are currently, but the market is like undecided where it will go. You can click on this link and you can understand what our logic is. What we are trying to say is we would like to understand how the zinc prices would move into the future, and that clearly would indicate where how the Hindustan Zinc should be priced as such. Now, one way to look at it is how are the zinc metal supply is expected to. So we believe that from 2015 to 2017, the zinc market will move into deficit. And generally, when we have seen that the zinc market has moved in deficit, let's say if you look at 2004 to 2007, you see that the rise that has happened from 2004 to 2007, the rise has been four times. While this has been aided to because of two reasons. One, the zinc market being in deficit, and the China being growing at a very fast rate. We do not believe that China, at least for next 2 to 3 years, may grow at a very fast rates as we had seen in the 2004 to 2007 period. But we still believe it will clock a rate much more above 5 to 6%, and which we believe, given the size of Chinese economy, is a substantially large size, which would definitely put a large impact on the zinc price. The other thing of importance to note is that amount of deficit that we are looking at. The 2004-2007 deficit was a much more smaller deficit than the 14 from 15, 16, 17 year deficit. And because of that, we believe that zinc would actually outperform most other metal segments. So we continue to remain extremely positive on the Hindustan Zinc Limited. So even if the disinvestment does not goes through, actually zinc, how Hindustan Zinc would end up outperforming and most of the metal companies as such. The next question is by Mr. Anshu Maheshwari. Miss Anshu Maheshwari. Uh, Her question is, I want to invest 2 lakhs amount for 6 to 12 month time frame. Please suggest name for 8 good companies. Anshu, I would just like to clarify, we generally do not give the 6 to 12 month horizon. Okay, the website is not geared towards helping investors and I make 6 to 12 months profit, but on a very broad levels. If I suppose if you were to concentrate largely your money in PSU banks, okay, especially like say like Bank of Baroda, PNB, uh, if you were to if you please avoid FMCG to large extent, concentrate on some blue chip pharma, not too much, but some like let's say Sun Pharma and Lupin. That would be the second. Uh, Probably Bajaj Auto, and to some extent not a large portfolio, but just say 10 to 15 percentage, I would still end up putting it in some value companies. The total of being 10 to 15, so EIL, BHEL plus say NMDC and Hindustan Zinc into 15, in which a large part I would still put in say Hindustan Zinc over others, because the likelihood that the decision for Hindustan Zinc would happen within next say 1 year or so. uh, After Hindustan Zinc, I would put it in BHEL, and after that, I would put it in EIL and NMDC as such, because NMDC also gives you about 6 to 7% return on the yesterday's price. Today's price of 105, it would turn around to be about say 6.5% return, I think. So that also is a one more good savior for Hindu NMDC, that you get a very high dividend also with NMDC. So let's say within that 15 percentage, if I had to break up 5 percentage, I would put it in Hindustan Zinc Limited. Another 4 percentage, I would put it within BHEL. The last 6 percentage, I would put 3% in say BHEL and NMDC and EIL as such. So this 15 percentage, even if they underperform over next 1 year, I am not much worried. But if they overperform, they should give a very large over performance to your portfolio. But the other, I would spread out in between banks and in between some large pharma companies. If I come across some other companies, I would definitely forward it to you to through your other customer mail ID. But please understand, Moneyworks4me website as such is geared towards helping you develop a develop a good portfolio strategy that would pay off over 4 to 5 years. So when we recommend companies like BHL, we ourselves do not believe that they would end up giving you returns in 1 year, but we also cannot say whether it has reached a bottom, but we definitely believe that over 4 to 5 years, it is very say commonsensical that a company like BHL will end up giving you extremely good returns. When I say extremely, it would be definitely much more better than what any other place you would have got in the market. uh, the next question is by Mr. Das Gupta. His question is, How is MRP calculated for operating companies? For banks, okay. If I get your question correctly, you are asking as far as what is our valuation process with respect to companies who are like financial companies and the others are normal companies. So let me get this right. If not, please let me know through the chat window if I have misunderstood your question. So let's look at a company. Let's look at Lupin, say for example. While this price calculator that we have given to you is a very simplified version, but this would, in very brief, will help me tell you what typically we look at. So, a operating company in which I do not have general problems with its quality of earnings, typically I would project its revenues, its cost, and the profit that it would make over next 5 years. This number would be distilled down to whatever its EPS is. So, over the next 5 years, and this would be then used to understand what the EPS growth that we are looking at over next 5 years. So let's say for Lupin, the base EPS, which generally should be the next 6 months forecasted EPS, but it need not be always be so, because sometimes let's say think about company like Sesagoa, because last year was a very difficult year for Sesagoa, but it was a one-off year, so the base EPS of ours would not necessarily match with what the company was reporting, because we have to think about keep how the because it is a one-off event that is contributing largely to the underperformance of the company, and this is a event that was not in the hands of the company and likely to turn around. We would take much more on the basis of what the trend of the performance of the company would have suggested. So as I said, we'll focus revenues, costs, and the PAT that the company would see over the next 5 years. This would be distilled down to its EPS number and the EPS growth that it would see. And on we understand that each of the every company, even after the forecasting that we have done, after suggesting that we have done, they have their own business economic risk, and because of that we would discount it back with respect to that number. To think of what we do, think of it this way: if I were to borrow 100 rupees from you and give you back 100 rupees, let's say a year from now, you have not got back the same money, because if you would have, let's say, invested in government bonds, that same money of yours would have been about 107.6 rupees. So unless and until I give you back 107.6 rupees, a year from now, you would be making a loss. So 107.6 rupees a year from now would be equivalent to today's 100 rupees. So this is what we mean by discounting. So a company that has earned, let's say, 113 a year from Lupin earns 113 a year from now, it is as good as it has earned 100 rupees today, because we are discounting it with respect to 13. This 13 number is more, while theoretically most people say it is with respect to what the investor expect as a return, but actually what it means is, given the riskiness of the business, what an investor should practically expect a return. So if the business is less risky, the expected returns would also be less. So if you look at some FMCG companies, this number would be very low. But if you especially companies with a very strong brand and strong business model. But if you look at let's say some metal companies, so if I were to look at, let's say, Tata Steel for example, let's look into Tata Steel. So if you, the way you saw Lupin was say around 13%. Let's go to his price calculator. So if you look, the number that we take is very high, 21 percentage for Tata Steel. The reason largely been that the amount of debt that it has, the fact that nearly much of its capacity in Europe is may turn out to be economically unviable over over next 2 to 3 years, uh, really scares the hell out of us. And because that risk that has crept into its local business also, that is local Tata Steel business also, we believe that Tata Steel as of now is a very risky company, and that's why its expected rate of return is also taken to be very high. The next number that you would typically look out is the PE number that you would give. This again is a PE that you would give not today, but you would give it about 5 years from now, given the growth aspect that the company would be staring at 5 years from now. And on that basis, we would value the company. Another factor that is also added is DPS. For margin of safety, we do a sensitivity analysis across multiple factors that impact the company's business model to understand what margin of safety we need to understand and how far the business economics can go bad. It is looking at more business economics and not at market expectation. So sometimes it do happens that while the business economics have not turned that bad as the market pricing is suggesting, but market has irrationally gone and the prices have gone very low. So that would be the case with, let's say, company like NMDC, for example, or our DP would be somewhere close to, I suppose, 130, 135, 146. So if you look at this number, even after giving margin of safety of 45%, it has still gone down, and we believe this is largely coming off because of the market irrationality. To put it very simply, at discount prices of 146 also, about 67 rupees in NMDC is just purely in cash. So if the company has 67 rupees per share just as cash, and its business, the rest of its business is coming out to you at the price of 146 at just 80 bucks, and this is for a company that makes a profit of about 16 in EPS terms. So you're paying a PE of only 5 if you were to really look at it, at the price of 146, and the current price of 105, it's like crazy price. 67 bucks out of 105 is just pure cash, and the rest, about what, 40 bucks is another what if the market is valuing it for its core operation. This is for a business that earns about 16 as a standalone EPS and gives out about 7 rupees as a dividend. So the dividend yield itself at 100 rupees was as high as the GSEC that I was getting at. So I think an NMDC is extremely very good buy at 100. Can it go another 5 to 10%? Yes. Given the global economic scenario that we are seeing, given the likelihood that you we may see another 5 to 10% correction, not immediately, but sometime later on in the year. I do believe that, yeah, it may go down below 105, somewhere in between 90 to 105. Unlikely to go below that, but even if it, I would suggest typically people to average out, but average out over large prices, not over months, not over this, but over large price differential. So if you have bought at 147, so 100 may be a very good price to average out. The next price I would typically look out then would be a 90 rupees price. This would be the way I would go about doing this. But NMDC, again, the thing to caution is NMDC might not end up giving you a good returns, or as far as capital gains are concerned, over next, say, next 1 year or so, but may give out extremely good returns over next 5 years. Extremely good returns would be somewhere around three times to four times a return over next 4 to 5 years, but not, definitely not within 1 or 2 years. I hope that explains. For same way we do for banks, but instead of price to equity number, we would be looking at how the asset growth would be, how the net interest margin would be, the NPS and the provisioning that the company is doing, and on that basis we'll come at its an EPS, sorry, its book value, that would be over the next 5 years, and the book value and the price to book value multiple would be largely be used to value banks. The next question is by Mr. Devji Patel. Is it advisable to purchase extra quantity of stock during hold positions? Uh, uh, Devji, this is a bit of a company specific question. If you would have asked a company specific view, I would have given a company specific view. Uh, See, if the payoff is very large and there is very little likelihood that things may correct over the next few months, then probably a hold, buying some more stocks in the hold strategy may pay off. But I would suppose that if you are ever doing this kind of strategy, I would request you to come through a customer care with that specific stock, then I can give you a much better view. I would not like to give a very generalistic view of adding a stock during the hold period that it is. uh, that's why we have also brought in buy sell plan. If a company is extremely good, like Asian Paint is, we also have a buy sell plan in it, in which we understand that because the DP is priced towards a very worst case scenario, which might not actually play out in the real case. Even a 5 to 10% fall in Asian Paints, typically below its MRP, we would give out a buy signal, because we understand that over long term, companies like Asian Paints, who have very strong business model and unlikely to have a very cyclical business in nature, so they would give out a strong consistent returns. They might not give a very large returns like 100% in a year or so, but they would give out 15 to 20% return each year and year, and which we would like our investors to have. But specifically, I would like you to come back based on stock basis, so I can help you out better. The next question is by Mr. Ishwaran. His question: what should we do in present market condition? I am a long-term investor. Can I buy shares like SBI, Bank of Baroda, and NMDC? I was just reading a research paper yesterday. It was paper in which some researchers had tried to analyze Warren Buffett's strategy. I am not going to try and glorify Warren Buffett over here. I'm just trying to tell what the researchers had to say. So these researchers, they had to say was that it is not that Warren Buffett's strategy actually pays off very high returns over long term. Their analysis suggested that the volatility in the Warren Buffett strategy also was very large. So because volatility in theoretical finance is considered as equivalent to risk, they said that on a risk return basis, Warren Buffett did not actually make very large return. So if you were to divide, say, a return of 25%, which Warren Buffett has been known with, and whatever the volatility of his portfolio was, it was not very large compared to Standard and Poor's return with respect to Standard and Poor's volatility. Having said this, yesterday I also read another research report, another research paper on Buffett itself, which was more on behavioral finance basis. So he said that typically long-term investors, when they invest, they would look out on a much more contrarian, much more on their strategy would be a strategy which would be considered naive by many of the other market participants. And because of this been considered as a naive compared to other market participants who have much more short-term time frame of say about 1 year or 6 months or just 1.5 year, it would not make sense for those investors. But those investors who have long-term investment strategy, they may see a very large volatility in their portfolio, because but they have long-term horizon in focus. Over long term, they would make a disproportionately very large return. So one thing that I've learned through that research paper was that uh, by in a long term strategy, it's not like you buy and you hold and forget, but it also does not mean that you buy and you, if you see a 25-30% fall, you become too panicky about it till the long term story ends up meeting our requirement of it being a value buy, it being a buy that would give us a substantially much more large return over long term. Things would play out, and this is definitely true with respect to your companies that you have mentioned, SBI, Bank of Baroda, and NMDC. Both of these, if you were to see, if I were to take you Bank of Baroda, I have already explained my case for NMDC. But if you still have doubt, please let me know through the chat window. I would definitely take it once more. So if you were to take out Bank of Baroda, let's see. I would not go through my valuation also. I will just try and force you to focus on just one number. Look at this number. Price to book value is 0.77. So unless and until we are expecting a very, very large write down, very, very large NPAs that cannot be covered through the company's profit of that particular year, and Bank of Baroda will end up making losses, we are effectively saying that the book value, meaning if the Bank of Baroda were to liquidate today and give its out shareholder, it would have given out 732 bucks as a standalone, 790 bucks as a consolidated company, 790 bucks. But the market as of now, which has a short term mentality of just 1 year or so, and wherein it believes that NPA may rise to some in a month, another say another 20 basis point or 30 basis point. It is just valuing it at 574. So will it happen over long term? Yeah, it would definitely happen over long term. But would it happen over short term? No, short term it might not happen, because in short term market would be looking at much more short term factors, next quarter's results, next in a something one more like Kingfisher bursting on its face, something of that kind. But what you need to understand is, till the company has price to book value that is below 1. Okay, this been one condition. Let me look at uh, till it has a very good CASA number. CASA number is not high at high 30, but it is also not a very bad CASA number. It has a very high CASA number. Till its net interest margins are, let's say, above 1.5% as such, Bank of Baroda would definitely do very well over the next few years. Might not do well over next 6 months to 1 year, but definitely well post election, Bank of Baroda may actually do well. Same reasoning would stand for SBI, but SBI would be at a much more higher price to book value. But given the size of SBI as a bank, I it is okay for SBI to enjoy some premium. But if you were to ask any value investor, he would just suggest you to just let us wait for another 5% fall, because the price to book value is about 1.05%, sorry, 1.05 times. So a 5% fall means that the price to book value is 1. So it would be something that, yeah, would be could end up giving you very good returns in the future also, given the growth that the SBI is seeing in its business. I think that answers uh, your question. Okay, if you have any doubt, just let me know through the chat window. The next question is by Mr. Ganesh. The long-term prospect of paint industry. Uh, uh, See, generally what we have seen is that the paint industry typically sees a growth of more 1.5 to 2 times of the GDP growth. Now that the growth has come down a bit, while the growth would be lesser in Asian paints as far as its sales number is concerned with respect to what it has enjoyed in the past. But if you look at other factors like per capita consumption of paints, we believe that the future of Asian paint is very good. Uh, there are two other businesses that Asian Paints directly depend upon. Uh, if you look, paints is predominantly used in two businesses, that is real estate and the auto sector. And unfortunately, both of the sectors are going through a very, very tough time. So if I were for looking at outperformance as far as Asian Paints is concerned, uh, if I see a revival in, say, auto business first, and probably later on in the real estate business, it would definitely work out very good for Asian Paints. However, I believe that on a standard basis, Asian Paints would do extremely well. It would continue to give its shareholders a decent return over its current price. But it would not definitely be an outstanding return. It would be somewhere in between 13 to 15% return that the company would go on rewarding its shareholders. And our this belief largely comes because of, one, the growth, the value creation index has been extremely good over last 10 years, and the growth also has been very, very phenomenal. I hope this explains. Asian Paints, you need not worry. I would rather suggest you go through just follow the advisory that comes because of the buy sell plan, and things would work out well over long term. Might not work over some short term period when the market goes through some wild fluctuations. Would definitely work out for you over the long term, giving a very good anchor to your portfolio. The next question is by Mr. Kamlakar Chaudhary. His question is putting stop loss necessary in your recommendation? Uh, uh, Mr. Kamlakar Chaudhary, we ourselves have a stop loss in our own recommendations when we give. So if we have given a recommendation of, let's say, NMDC at, let's say, 136 or 138, and the stock has fallen 20% below it, it goes through a review within the panel itself. Definitely, and it is evaluated. If we see that it is something that is market is been too short-sighted, or market has been too panicky about it, we would not definitely change our recommendation. We would generally issue just a cautionary statement or an advisory that the investor should use the price weakness to buy into the stock at lower levels and average it out. But we continue to believe that the price would definitely end up giving the investors a much better, uh, very outsized return over long term. But however, you should definitely always maintain a stop loss as far as your investment uh, goes. So till you are with us, what and you are following my recommendations, what I would rather also advise you is, if you see that uh, uh, we have made some recommendation and you have followed it, and that recommendation has not worked out for you, please let us know through the customer care. We would get back to you immediately, not more than over a week's time, and we would let you know what our view is. If it's a view like NMDC, we would tell you that please average it out over these falls, large falls. If it would have be a company like Opto Circuit, we will tell you, boss, we made a mistake and let us get out of here. We'll find some better opportunities to make money. And if a case like Opto Circuit happens, and you would see the fallout of an Opto Circuit on our website also now, we are going through a radical redesign of 10-year X-ray now. We have understood that there are some places where companies like Opto Circuits get missed out, and we are implementing that now. So if that may be the reason because of which market knows something that we do not know, and we would radically recorrect ourselves, and we would rather than holding our position on based purely on ego, we would go out and say, sir, we made a mistake, let us get out of this, save our capital, and let us make investment somewhere else where we can make a much more better returns, like in a company like Asian Paints, which may give out decent return over long term, or in a company like BHL and NMDC, which have fallen so much that we believe that over 4 to 5 years they would give us an outsized return that would even cover up the loss that we have made in our and a wrong investment that we have made. So yeah, if you should have a stop loss in your portfolio. Be assured that we also have a case like stop loss over here. If the prices after we have given a buy recommendation falls down below a certain point, we it goes for a much more deeper level of analysis, wherein a team of senior analysts looks into the buy call, and they would see if the over long term, over next 4 or 5 years, does the investment thesis still holds. If not, then we would come out and say this, we made a mistake over there, and people should just kind of book their losses and get out to better opportunities in the market. The next question is by Mr. Nasim Rao. Uh, his question is, unfortunately, I invested in metals and Crompton Greaves, and my portfolio is 29% down. Should I pull out money? See, as far as metals is concerned, till you have not invested into, say, a company like Hindalco and Tata Steel, or Jindal Steel and Power Limited, all these three companies are rated red, largely because they have used too much of debt to fund their capital assets. But let's say if you have invested into Moil, Hindustan Zinc, NMDC, which have been weak over the last few months. If you have invested in Tata Steel and Hindenburg, please get out. Better let us book our losses. These are very high risk companies. Can Tata Steel be a multi-bagger? Probably yes, if it becomes a turnaround story. But how big that probability is, how I do not know. And I think that companies like which are going through turnaround phase, while they end up giving very huge outsized return to the investor, they come with a huge amount of risk also. While they may be very good to have, but in a very small percentages. So if you have companies like Tata Steel, Hindalco, there may be a case to please restrict those investment to not more than, say, 5 to 6% total into the your portfolio. But however, the case are with respect to NMDC, Hindustan Zinc, and Moil, these kind of companies, or even Maharashtra Seamless kind of companies, companies with very strong balance sheet, companies with very strong business model and profit margins, then I would rather suggest that these companies would work out for us over long term, over next 4 to 5 years, but might not work out in the short term. Short term, uh, probably over large percentages, we may even think of averaging out, unless until it becomes a too large a chunk of your portfolio, but because otherwise it would just become dependent on just metal sector performing and would not be diversified enough. But unless until that condition is not violated, I would average it out. As far as Crompton Greaves is concerned, Crompton Greaves is going through a very critical phase as such. Uh, Crompton Greaves is going through a very critical phase as such. Just give me a minute. Yeah. Crompton Greaves is going through a very critical phase as such. For Crompton Greaves to really do well, what I would actually look out a very broad number, broad thing to happen is for Europe to stabilize. Crompton Greaves gets a large amount of its business through its export business and through its international business through its subsidiaries in Europe. For if the Europe were to stabilize and investment cycle were to pick up in Europe, Crompton Greaves would actually do very well. But as of now, I'm a bit circumspect of how likely it is that it would happen even over next 3 to 4 years. So probably now I would ask you to get out of it. But probably if once things in Europe start settling back, we can look at re-entering into Crompton Greaves as such. See, because if you speak to engineers who use the Crompton Greaves product, they would say that the product is actually very good. So the products are good. The company business model is decently good. It is only seeing a pain largely that is coming off because of the weakness that we are seeing in the investment cycle in US, sorry, in Europe, and to some extent in India also. If at least India would have been doing well, things would have worked out well. Another thing that you can just keep out eye for is just the ROCE number. Crompton Greaves is not going anywhere till its ROCE improves back. So if you were to look at this period, let's say in March 2004 to 6 period, you can check it out in money control. Probably we do not have, unfortunately, very long 10-year graphs, but let's just to check out at say money control in between this period. You would see that Compton Griff didn't move much in between 2003 and 2004, but 2005 to 2006, when its ROC and its value creation expanded, had given a very huge outside return. So you won't lose much if you get out now and re-enter once things stabilize for Compton Griffs and it starts doing well. So my suggestion would be get out of Compton Gives and get out of companies like Tata Steel and Hindalco, because these are companies with very overstretched, very heavy balance sheet, and that is why I would tend to avoid them because they bring unnecessary risk into portfolio without the hope that it would recover over the long term. The follow-up question by Mr. Kamlakar Chaudhary is 20% stop loss appropriate for buy stocks? Uh, yeah, but Kamlakar sir, just keep in mind we ourselves have 20, so 20% stop loss. So you may even actually start working out with say 15% when you are with us, because 20% I myself have a stop loss at my end. So 15% you can also act like an early warning signal for me that something is going wrong, guys, please check out over here. So that gives us a good latitude. So till you are with me, I would rather suggest keep 15% stop loss. If it was in this, you would act like my early warning, and it would help all of us to avoid some mistakes that we have made in the past. And if our investment thesis, like, it still continues to hold even though it has come down for these companies like BHEL, NMDC, Hindustan Zinc, if it still holds, we'll rather end up suggesting you to please average it out. But if it does not hold, we'll rather get out at the fast. So you can keep something in between 15 to 18% as stop loss, because why I'm keeping asking you to keep a much more lower stop loss than what we have internally is largely because the market has been very volatile and is likely to be so volatile for the next 1 to 1.5 year. So my personal expectation is the market would not move beyond 5,500 on the downside, and 6,200 to 6,300 on the upside. This is the cap that I'm putting at on the on a very tight basis. On a very expanded basis, I would keep a downside of 4,800 on the downside and 6,600 on the upside, because uh, the I foresee a large probability of 5,500 and 6,200 to play out much more. This is just 15 to 20% range between the two extremes. So market is likely to be very volatile. So just be a lookout. Uh, there may be some very good investment opportunities that we may be missing out, and some companies may be becoming very coming at a very lifetime lows that can make a very good investment case for our portfolio as such. The next question is by Mr. Paresh Maru. He wants to know what is our view on Pidilite. We believe Pidilite is fundamentally very strong company. It has very strong brands, especially the Fevicol brand. Uh, and yeah, Pidilite, just like similar to like Asian Paints, continues to have very strong value creation also. Yeah, except for one off year, most of the time it has had very good years, a very strong value creation also. So we continue to believe Pidilite is a very strong this. However, Pidilite is also trading much more above our MRP. I just wait out for some time. If it were to come down somewhere close to just below my MRP at, let's say, somewhere around 245 or so, I think we can think about Pidilite, putting our some money into Pidilite also. I think that should help answer your question. So as of now, I would just wait out for Pidilite, but yeah, it is definitely a very good company. But if you were to buy at 267, it might not give you out some returns, great returns to you for 1 or 2 years. Probably sometime later, it may do very well for you. Uh, and for because of that reason, I would suggest that let us wait out, and because market are also likely to be very volatile in these next few months. So let's see if in this volatility we would get Pidilite at a very good price or not. Your other question is also on is a question on Wokard. Uh, Wokard has been a very good turnaround story, and the company had filed for a CDR and it has come out of a debt restructuring program, and after that it has been clocking a very good performance. If you remember, about 2 or 3 years back, Wokard had also sold off its hospital business to other firm, and this has helped to substantially reduce its debt burden also. The stock has done extremely well over last 3 years. If we were to look at Wokard, let's look at Wokard. But definitely what we believe is Wokard has quite outrun the whatever the fundamentally strong valuation it may be, it should have been. So the turnaround story is now a bit oversold story. Yeah, this is Wokard. So if you to see 3 years, you will see a very strong rise in the Wokard. Typically, I'll just add out this as a cautionary. If you see that over a period of just 1 year, if your money is getting 3 to 4 times, please just get out of it. These kind of straight line rallies are very unlikely. Things would come up after that with a very strong correction, and because a major part of the this rally would have been by because of people buying into the story at a much more fag end of the what the valuation would really justify. So actually, Wokhard may be coming at a somewhat decent price as of now. May see another few percentage, another 10 to 15 percentage price correction. Uh, but please stay away when you see a very large sustained rallies above 3 to 4 times in a period of just that is very in a period of very small 1.5 to 2 years period. If you see a very strong rally, just get off it. So if you see Wokat started sometime around Jan 2012, and just around by Feb 2013, that is not even a 1 year, it had given a 300% return. So if you see something like this, just get out of it. This is most likely something like a bubble, and when it cracks, we see a very sharp correction. So Wokat, yeah, it was a it is was a turnaround story, very good turnaround story, but we believe it has largely been played out. The next question is by Mr. Pawan Belari. His question is Syntax a buy for 4 year as attractive valuation? Is IDFC a buy at this level by considering the banking loan license? Uh, I'll take the Syntax question first, and then I'll enter into the IDFC question. If you look at Syntax, the problem with Syntax is largely the balance sheet that has got stressed because of the debt that it has taken, and major part of its debt has been taken to finance the working capital. Let me go to 10-year X-ray Pro. Yeah. Uh, uh, so if you see the working capital days, if you see working capital days also, the numbers have been steadily been increasing, and this is what I am telling you, that the working capital days have been steadily be increasing, and this has been financed through debt, and this has largely become the Syntax core problem. The good part with Syntax is major part of this debt is largely with respect to government paying off late. So it is not likely that it would default as such. But for things to really work out for syntax, uh, uh, for things to really work out for syntax, government itself need to get its finances right, and which is at about a 3.5 to 4 year story, and only after that things would start working out well for syntax. So you may have some exposure to syntax. Just the only cautioner I would add is, within your portfolio, do not have a very large exposure to companies like syntax, because when they would turn around and when they would start giving out real returns to the investor, it would be very outsized. But if, let's say, there is a fair probability that if that does not happen, things may actually go very bad, and we may see very large losses for our in our portfolio also. I would rather suggest, sir, let's have, let's say, not more than 5 to 10% in these kind of companies. As in, all these kind of companies should come down to some of 10 percentage of your investment. So if you have, let's say, Syntex, Tata Steel, Hindalco, all these companies taken together should not be more than 10 percentage. Uh, if even one of them then plays out, it would really give a very large return to our portfolio. So if you are following that caveat, yeah, at 40 syntax may make some sense, but please be aware that balance sheet is stressed. There is a very good possibility that the company can see a bankruptcy like scenario also. So just because of that caution, I would suggest not more than 10 percentage in companies like syntax, which who are seeing balance sheet stress. But otherwise, given the strong brand that the syntax have, I would be much more comfortable with syntax at the price of 40 or so. Yeah, the other question was with respect to IDFC. It just slipped from my mind. Let's go at IDFC. Uh, One thing that I would like as a caution to everyone who is looking at banking space, see, RBI is likely to give out banking license, but it is not going to give out this banking license to each and everybody that applies. My personal expectation is that not more than two to three banks may, financial entities may end up getting banking license, and in that the bank RBI would also see how strong their understanding of the financial sector is also. So while people may get excited about L&T Finance and say other companies getting into banking sector, I am bit doubtful whether they would really qualify for banking sector or not. So if you are the thought process on the basis of whether the this makes a good sense on the sector license itself, I think that story may already be overplayed as far as all the banks are financial institutions that have run up are concerned, and maybe due for some correction as such. So while IDFC definitely again would not, the banking license might not play out as a good story for IDFC for now, because that has already been captured by the market. The one thing that I would definitely look out for IDFC is whether the weakness in the current PSU, like financial industries, whether it would lead to a price to book value of less to one. Even if it is marginally less to one, it is much more substantially better methods than with respect to PNB, Bank of Baroda, and SBI. So I would give it a bit of a premium over there, but still I would look for a ratio close to one. So if it comes down to one, I would definitely look into investing into IDFC as such. The next question is by Mr. Shenji G. His question is, what are prospects of Tulip Telecom? Uh, if you look at Tulip Telecom as a company, I don't think we covered Tulip Telecom as such, if I'm not wrong. But let me have, even if it is, it should be suspended, or should be, yeah, we do not cover Tulip Telecom as of now. And I will still give you my view about it. Uh, we see that the Tulip Telecom share price has seen a very high decline. So let me do one thing. Let me go to money control as such, because it would be very hard for me to uh, even show you the share price of. So some problem with money control, that seems okay. No problem. Let's go to say Google Finance. That should also serve our purpose. At least I can show you the graph then. Yeah. So if you see that sharp fall that we have seen in telecom is largely because of the high redemption pressure because of the FCCBs. That is one. It has seen a very high capital expenditure. Working capital requirements are also large, and further large investments have to be made to fund its future growth. So we believe that it is very unlikely that telecom may recover. Uh, the results have of this year also have not been that good. Uh, we also believe that because the company has very high pledging, uh, generally pledging generally pledging itself does not troubles me a lot. If it is it only starts troubling me when there is a very high balance sheet stress also built in, because it says that the pledging is largely because of the company cannot secure get a secured debt, or cannot, and the bank does not has very high confidence on the uh, ability of the company to pay off its debt. So I would rather not be invested in telecom. If you have been, I'm extremely very sorry for it. I would rather recommend get out of it. Uh, if it is very small marginal investment, if it works out fine. If uh, I expect a market probably may move out back to somewhere close to 6,000 over next few days. If it you get some upside over it, fine. But this is just call on short term market play. If it works out well for Tulip Telecom, then I think it's okay. But otherwise, I would suggest to get out of it. It's certainly not a long term investment company. uh, uh, the next question is by Mr. Shamalendu. I'm sorry if I misspelled your name. Your question is with respect to Gitanjali James. Artist has been seeing a very bad last few weeks. Yep. Gitanjali James. Uh, I. Yeah. Uh, Gitanjali James, yeah, it has seen very sharp price correction over last few days. Uh, I'll give you my understanding as far as I've not looked into Gitanjali Gems very in depth, but I'll give you my understanding of how Gitanjali Gems is. If you look at our MRP and DP also, it is just now starting to correct towards our MRP. Okay, and we do believe that it may even reach our DP also as of now. Okay, uh, what we had factored in was that there is a very good likelihood that with the US economy becoming better over next 2 through 3 years, there is a good likelihood that the Fed may eventually start thinking of tapering of quantitative easing. Uh, though the phase two of what I would say now, the fact that it will start reducing its balance sheet, that is start pulling out money from the markets, is quite a many years away, probably 4 to 5 years away. But whenever this would happen, and this is something that is going to happen over gold is likely to underperform. And for a jeweler, when gold underperforms, while his margins might not that get impacted, because you see he buys gold and then sells gold, and when he sells gold to you, he's also selling you at the whatever the current price of the gold was. Until he can, until and unless if he can keep his working capital very strong, uh, working capital finance very strong, he need not have much to worry about. So uh, which if you see for Titan happens, but if you see for Gitanjali it does not happen. So think of it this way: he has working capital, net working capital days of 155 days, and working capital days of 243 days, meaning he buys gold out at the start, nearly at the start of the year, and sometime in the middle of the year he ends up selling it to you. In the 6 months, if the fluctuations are very high, he may make large losses. And because of this reason, and the other fact that the ROC has not been very top notch compared to his peers like Titan, we have been very negative on Gitanjali Gems. However, having said that, if you have invested into Gitanjali Gems, my the very fact that the tapering of QE by Fed is unlikely to happen very anytime soon. Once the market realizes this, I think gold may again start picking up price. So there may be a chance for you to recover something, but this is just a chance I am speaking about. I am not speaking about with certainty. Uh, with certainty, I do not know how things would pan out for Gitanjali Gems. The reason being there are multiple pressure points that are building up on Gitanjali Gems. One being the gold price being correcting. Second being that the regulators as well as the government both are focused on get and trying to limit the import of gold because they uh, at some level believe that gold consumption by Indians is contributing to some level of CAD deficit, current account deficit, which is putting a huge pressure on rupee. And if they have focused on at such level, I would not take uh, uh, a bet against, say, RBI as such. The recent norms as well as the gold price collapse have been largely been the reason. I believe that going forward, the regulatory norms would only get tough for most of the jewelries companies. This is not just CAD issue. This is also the issue of black money getting converted into white money because of the use of gold as a medium. So I would believe that regulatory environment is only going to get tough for jewelers. On the other hand, I also believe that over next 4 5 months, probably gold may recover. But I am not a gold commodity analyst, so I may be off by a very large margin over here. So yeah, there is a chance that you may recover your investment you have made. But if you have not made your investment, I would ask you to stay away from Gitanjali Gems. Much better prospect would be to have exposure through Titan as far as a jewelry business is concerned. Uh, The next question is by Mr. Ashok Kumar. His question is it good time to buy Kane, PNB, which are below DP? Uh, for PNB, we had already issued a buy signal. I do not know if it has uh, become off by some reason. Let me look at it. I think PNB should still be in the yeah. So if you see in time to buy, you see that we have already saying that PNB is a good time to buy. There will be some near time to 5 to 10% correction. But however, we believe that yeah, PNB will end up giving very high. Yeah, so extremely sorry for the mishap. Uh, as far as Kane is concerned, the only one cautionary note I would add is Kane, yeah, you can add a DP. The only one cautionary note I would add is the oil price in the global market is also been weak over last few weeks. I have not checked how it was yesterday, but oil prices also have been somewhat weak. So falling oil prices may be a bit of negative for Kane. However, having said that, I would use that weakness of oil prices to buy into cane. And the fact, the other fact is the gas price hike. I believe that it is marginally positive, not very high positive, because cane does not produces too much of gas, and it does not has a acreage as of now through which it can. It's likely that it would see very high gas production also. So I would use the weakness in the oil price to add. So just buy into cane with some patience. With do not buy, if you are planning to buy cane India. With you are planning to invest, let's say 1 lakh rupees into cane India, I would not go and right ahead invest the whole of 1 lakh into cane India. What I would rather do is I would invest some amount, let's say about 25 to 30,000, and then later on I would add, if cane were to fall down to 280, I would add another 30 35,000. If it came were to come down to somewhere around 250 to 270, I would add another 30,000. So I would wait out that way. Because oil prices are going weak. If the oil prices do not go weak and they come back to 110, in which time I would get back to you, then probably we can go full hog. But because oil prices are weak, I would like to use that opportunity to get a very low, as low a price in cane India as possible. That's the only caution I would add. But otherwise, if you have 5 years outlook, yeah, cane India at 289 looks a good price to buy into. HUL, I would your next question is on HUL, Mr. Ashok Kumar, and HUL, I would rather suggest please don't buy at current prices. HUL at current prices of around I think 580 or so is like a company can go do no wrong. A 580 type valuation of HUL means, and the market is effectively pricing that HUL profits will grow at the rate of say 17 to 20% each year, which may happen some year. I do not say that it might not happen some years, but I don't think it would happen every year for the next 4 5 years. So I believe that HUL is way above its fair value. I would not suggest you to invest into it. If you have some HUL shares, I would rather suggest you to please get out of HUL by using the open offer as such. Uh, uh, Same is with respect to ITC also. If I see, yeah, I think the ITC is much better placed than HUL, but I would not suggest you to. Okay, so ITC has corrected a bit. I was under impression that it is much way above our MRP. So I would just wait out for some time because ITC is also very good company. Another few, I think, 3 4 rupees correction, and you should see a buy signal coming on ITC also. So ITC makes out a very good buy, but only over a long term, and you will get should not expect a return of not more than 15 to 16 percentage each year. So that is a return, but ITC similar to like Asian Paints would be a very good hedge. But as far as HUL is concerned, please don't enter into HUL at current prices. It is way expensive. I have very simple metric when I look at companies like HUL. I would and give out this thinking of HUL, let's say. Uh, and typically, I've seen that this strategy works very good over long term. So let me dive in detail. Uh, my simple strategy is I would sell HUL whenever it is close to 33 to 35 PE, and I would buy HUL whenever it is close to 25 to 27 PE. At 33 35 PE, effectively the market is pricing in that the company is going to grow by 15 to 17 to 20 percentage, which is unlikely. And around 25 PE, and this is only for HUL I'm saying. Okay, around HUL around 25 PE, effectively market is saying that it will not even grow by 6.5%, which is as if it is saying that a company with a very strong brands will not even beat inflation. So I believe that buying it at the price when HUL whenever it is at 25p and selling it somewhere around whenever it is 33p uh, gives a very good returns over even in a short term durations, like in a 8 months 10 months duration. So whenever you find if you can historically test it, you whenever you have found HUL at 25 and you would have entered it within a period of 8 to 10 months, it would have recorrected from PE of 25 to somewhere around 30, and that would have meant a return of 20 to 25 percentage, which in a period of 6 to 8 months is very good. But as being said that a PE of 33 for HUL is on the very high side, so I would not try and enter into at this time. Neil Narayan, the next question is by Mr. Neil Narayan. His question is with respect to Renuka Sugars. Neil, the good part about Renuka Sugars is that we have reasonable basis of believing that the sugar cycle may be on the upturn. Okay, I also think that the its Brazilian units are doing well as of now. So this may help hedge some of the debt increase that the company has seen in the recent past, and the only thing I would look out for is for value creation index to become a bit positive before entering into Renuka Sugars. Having said that, Renuka Sugars, I understand, is a very low price. Uh, uh, Till you restrict it to just 4 to 5 percentage, I will take Renuka Sugars in the same category as the balance sheet stress story that I was saying to you in my webinar. Companies with balance sheet stress like Tata Steel, Hindalco, uh, Renuka Sugars, Syntex. These are the companies that should not form together more than 10 to 15 percentage of your portfolio, assuming you are a very person with a very high risk appetite. So if you have very high risk appetite, then only they should form 10 to 15% of your portfolio. But if you are a person with a very low risk appetite, you should not have even them in your portfolio as of now, because these are companies with very high balance sheet stress. Having said that, yeah, so sugar prices are likely to turn on the upside over next 2 to 3 years. Uh, its Brazilian operation is also now stabilizing. So these are the two positives that I'm very happy as far as Renuka Sugar goes. So I'll just wait for its annual report to come by, and we can then see if Renuka Sugar now starts making any sense to us. Okay, for invest as far as the investment goes, its standalone performance has been good as far as over the quarter, but my concern is with respect to its Brazilian performance. If it is stabilizing and if it is moving towards a turnaround, probably we can think of Renuka Sugar later on as a turnaround. For as of now, I would just ask you to stay away from it. If you want to initiate, do not initiate more than say token investment in Renuka Sugars as of now. Given the fact it is around 16, so probably because market is bullish, you may see some return, but otherwise just a token investment, not more than that. Okay, the next question is by Mr. Ravendra Kumar. His question is with respect to Godrej Industries. Can he buy at 300? The other is as far as Godrej Industries is concerned, I would think please get out of Godrej Industries at 300. There are better opportunities in the market for investment worthy. You can definitely look at Pidilite. You can look at Maharashtra Seamless also. It has had very good. It has very strong balance sheet. The company is also doing a buyback, so that reaffirm that the company has a very strong balance sheet. So you can look at Maharashtra Seamless, just like I told you with respect to metal companies, to play out over next 4 5 years might not play out over in next few months. So use the weakness to buy into it. So do not go overall whole hog into Maharashtra Seamless. Madras Cement, the South industry in cement remains continues to remain weak. So you can look at Madras Cement as such because it is one of the strongest player in the south. And however, same just like Madras Cement, uh, just wait out for few months, especially for its annual report to come out, and for us to dive in deeper and do valuation of Madras Cement, and then probably we can think of whether we should get into Madras Cement or not. About Hindustan Zinc, may would definitely should work out over next 2 years. I think the price of 100 is very good price for Hindustan Zinc, and if it falls down, you should average it out as such. I think this would work out very well for you. Stay away from Godrej Industries. You can buy into Hindustan Zinc. That would work better for you. The next question is by Mr. Vinay. His question is with respect to Page Industries. So let me have Page Industry in my decision maker. Yeah. Just let me see if there are any questions that I have missed out. Okay. Okay. So as far as Page Industries is concerned, we did some stress testing of valuation as far as Page Industries goes. We saw that the current market price of Page Industries is definitely very high. Uh, Even after thinking about whatever the growth it may get because of Speedo and the store expansion it is doing, while we believe that the company is very good with a very strong brand and very strong margins and very strong dividend payout ratio also, we believe that the price of 4097 is a very high price, and probably this is not a price that you should look into for entry. But yeah, if you have entered at a lower levels and you are sitting on decent profits, I think you may think about uh, selling your investment in Page Industries and moving to other better pastures. There is possibility of another 5% upside, largely because of market moving up. But this is just a hope that I am giving. It's just a chance on the basis of which I am saying. On a reasonable basis, I would rather expect Page Industries to also start correcting towards our MRP in near 6 to 8 months future. The next question, follow-up question is by Mr. Ravendra Kumar. He wants to understand what call should you make in between DP and MRP? Can we buy such stocks at their market prices? Uh, See. if the stock is a very good stock, like let's say Titan, there may be, or let's say ITC or Asian Paints, there may be a case for even buying them in between MRP and DP. But if there are cases with a company, even like say very good company like BHEL, I would rather suggest not to buy it even at close to DP also. Lastly, one thing that I would like to announce when I'm making this statement, I would like to use this opportunity is we are coming out with a methodology to identify such companies for you. We don't want it to be exposed. We want it to be ex ante so that you are pre-aware what, and we can set your expectations right as far as your portfolio is concerned. So you may be seeing some symbols that may come over next few weeks, just where the mid cap and textile we have written. This will start and identify companies into six broad categories. One is a laggard, companies that are growing very slow, companies who are lost their way, companies who are not doing very well for a considerable period of time, not who are not doing well for just short term, for because of some specific reasons. Then you would see companies who are stalwarts, the opposite of laggards. They are companies who are doing extremely well. They may not be growing at a very fast rate, but they have been performing extremely well over a considerable period of time. Companies like Asian Paints, companies like Pidilite would be typically companies in this category. Uh, HCL Infosystems may be the other company. Okay, so I say laggards, stalwarts, and then growth companies who are going through a very high growth phase. Companies like Page Industries going through a very high growth phase. They might not typically also maybe giving out dividends, and, because they need much of the cash that they are generating to fund their own growth. But these are companies that are going with a very rapid phase, like they are seeing 30-35% growth. Companies like Page Industries, Jubilant Foodworks, they would be typically these kind of companies. Laggards, stalwarts, growth. Then the other are value companies who have a value inherent within the business, like say Punjab National Bank, wherein the price to book value itself is less than one, or let's say sale, or let's say what can I say? Let's say EIL, PHEL. These are companies in which they have substantial assets. Uh, in these are companies which have substantial assets compared to uh, in on the balance sheet compared to what the market is valuing. So these would be the companies that have value, and the other two are cyclical and turnaround. So in companies which are cyclical and turnaround, please be cautious. BHL would be a cyclical company. Companies like Tata Steel are a mix of both cyclical and turnaround. So these companies can fall much below their DP also. While their long-term investment thesis may still stand, it's not necessary for us to go whole hog the moment it reaches DP. However, on the other side, a company that is rated stalwart, there may be a decent case for arguing that even if it is just, let's say, 5 to 10% above DP, there may be a case for investing into it, because at the end of the day, this is not a precision science. This is at the end of the day an estimate that is being made by people. So please look out for those signs. We would get back with a special webinar also on once we introduce those signs, so that we can set your expectations right. Please be in that webinar so that we can help you better. Uh, the next question is by Mr. Kumaraswamy. His question is why ITC went down when Sensex went up. The last time I checked, it was not so. ITC also recovered in the later half. Yeah, ITC also recovered in the later half. So I think when he was observing, ITC may have gone down, but it has then later on recovered. The next question is by Mr. Vinay. His question is with respect to Kaveri seeds, whether he can continue to buy Kaveri seeds at current level. Kaveri seeds, the only one thing is, yeah, we like Kaveri seeds at some level, but we are not very confident about, we are not very confident about giving it out as a recommendation as of now. So, right now, while we are intrigued by the business model of Kaveri seeds, and we would like to study it deeper. But as our MRP also suggests, Kaveri seeds may have actually gone up quite substantially bit. So I would suggest please wait out for Kaveri seeds. The very there are few flags in cover receipts that I would like to check out first, and after that I would probably get back to you for whatever view would be on cover receipts as of now. So we need to do a deep dive analysis on cover receipts, and probably I can answer and you better on cover receipts later on. Uh, the question is by Mr. Murali. I purchased LNT at 1600. What should he do? Uh, Mr. Murali, I am a bit biased with respect to LNT. I generally believe those are LNT is a very good has very good engineers, very good capability as far as engineering goes, but I don't think they have very good business model set in it. So if you were to look at the value creation index as far as L&T goes, I have seen that it makes no sense as a businessman if I were to run this kind of business. The other red flag that I see with L&T is if I were to do summation of say L&T's and operating cash flow over last 5 years, then it comes around to somewhere around close to minus 7,000 crores or so. While if you were to do 5 years and summation of all the profit, it has some profit of 20,000 crores. So this dissonance between what the net profit is and what the net operating cash flow is very, very a big red flag for me. So I would actually rather cut my losses and get out of L&T. I would rather end up investing in companies like BHL who have much better and a probability of doing well. Uh, One more thing to look out for is if you were to look at debt to net profit for L&T, it has been consistently rising, which also is not a very good sign for L&T as such. So I would suggest that please get out of L&T. Probably in the rally that may follow over next 1 week, you may get some opportunity to exit it at a higher price. But I hope you can get it up to 1600. But I would not have L&T as far as my long-term investment is concerned. I would not have L&T in my portfolio. So another follow-up question by Ravindra Kumar. Uh, I This is the last question I would be taking. If you have any further question, just let us know your question through the customer care, and I would be glad to answer them. Uh, the question is, it will be nice to keep the list of suspended stocks which are to be looked into and suggest some view on that stock. I'm just confused whether we should invest in them or not. Yeah, Ravindra Kumar, typically, henceforth, whenever we are suspending any stock, you would be seeing a note that would be put out that would tell investors what our final belief is about that stock, and would end up advising investors on what to do about that particular stock and how our advisory pans out for that particular stock. We would definitely be doing that particular thing for us. I think that would help you take a right decision about stocks that you may have in your portfolio and for which we have suspended the valuation. But one thing that you need to focus on is typically a suspension of valuation also means uh, that we are generally not very positive on the business model of the company, and because of that reason the suspension has been done, because we do not foresee anything good that can come out of investing into that company by our investors. So while lastly this would be one broad reason why we are suspending a company, but definitely whenever we suspend a company one off, you would definitely see a note on why the suspension has been done. Uh, the last question is by Anand Joshi, which I would take. To whom should I address our stock specific queries? Uh, Please address your queries through your mail to customer care at moneyworks4me.com. They would forward it to the concerned analyst. So if you have query with respect to metals, then it will go to the metal analyst. If you have query with respect to FMCG, it goes to the FMCG analyst. Even if you have query with in which we have mix of the stocks, it would go out to each of the analysts, and then they would be collated and sent out to you. So if you have queries, please send it out to customer care at moneyworks4me.com. Uh, with this, I would like to conclude today's session. It was great having you over here. Happy investing, and please stay connected with us and let us know what your view is about our website. And if you have any advisory, please let us know what we should be doing better to help you make much more better money in your investment. Thank you very much.